Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 14th of April. Let's dive into the week's stock market news. Trade tensions shake European markets. Central banks increase scrutiny amid economic concerns. European financial markets experienced significant turbulence recently as escalating trade tensions weighed on investor sentiment. The Pan-European Stocks Europe 600 index finished 1.92% lower in local currency terms during the period of heightened concern. Major national stock indexes across the continent also registered notable declines, with Germany's DAX falling 1.30%, Italy's FTSE MIB decreasing 1.79%, and France's CAC 40 index losing 2.34%, while the UK's FTSE 100 index slipped 1.13%. Markets did see a partial rebound, narrowing losses, following comments from US President Donald Trump suggesting he would delay the implementation of threatened reciprocal tariffs against most trading partners. This market seesaw, initially sparked by the tariff announcements, prompted central banks in the Eurozone and the United Kingdom to intensify their monitoring of financial institutions and market conditions. The European Central Bank urged banks to conduct more frequent checks on deposits and other forms of funding. In a similar vein, the Bank of England both sought information from lenders regarding market liquidity and inquired whether hedge funds and other significant clients were encountering financial strain. Acknowledging the market volatility, the BoE adjusted its bond sales schedule for the second quarter, postponing auctions of long-dated gilts. Concurrently, its Financial Policy Committee cautioned that further market corrections could occur, emphasizing that the fragmentation of global trade combined with stress in financial markets poses a risk to financial stability by potentially depressing economic growth. Adding to the cautious atmosphere, recent economic indicators presented challenges for some of Europe's largest economies. German industrial production contracted by 1.3% month-over-month in February, following a 2.0% increase in January, with output declining in construction, energy, and food sectors, though partially offset by expansion in electrical equipment manufacturing. Italy also experienced a downturn in industrial output, which fell 0.9% sequentially in February and registered a 0.7% decline for the December to February quarter compared to the previous 3 months. Furthermore, Istat, the Italian statistics agency, reported that the nation's economy grew by only 0.7% in 2024, missing the official 1.0% forecast. Subsequently, the Italian Treasury sharply downgraded its gross domestic product (GDP) growth projection for the current year to 0.6%, a significant reduction from the 1.2% forecast set last September, reflecting concerns possibly linked to Italy's substantial trade surplus with the US and potential tariff impacts. In contrast, the UK economy showed unexpected resilience in February, expanding by 0.5% month-over-month. This growth, driven by stronger services output, significantly outperformed the median forecast of 0.1%. On a year-over-year basis, UK gross domestic product increased by 1.4%, also surpassing consensus estimates. Nevertheless, despite this positive surprise, financial markets continue to anticipate that the Bank of England might accelerate its cycle of interest rate cuts this year. Now our insight into alternative markets. BlackRock sees private markets gaining appeal amid tariff uncertainty and market anxiety. A climate of uncertainty and anxiety regarding the future of markets and the economy is currently dominating conversations with investors, according to BlackRock Chairman and CEO Larry Fink. Speaking following the release of the firm's first quarter earnings, Fink highlighted the significant impact of recent U.S. tariff announcements, describing them as going beyond anything I could have imagined in my 49 years in finance. He noted the widespread effect on ordinary people's retirement savings due to increased stock market participation, while acknowledging the current period of geopolitical and economic uncertainty. Fink drew parallels to previous major market shifts like the financial crisis, the European debt crisis, and the pandemic, stressing BlackRock's history of navigating such times successfully. However, he differentiated the current downturn, stating, "We do not see systemic risks. There is not a pandemic. The financial system has shown it's safe and sound." He pointed to the market's resilience and liquidity despite the volatility. Amid questions about risk and asset reallocation, Fink emphasized that mega forces like artificial intelligence, surging demand for global infrastructure, and an ongoing evolution of debt financing present transformative investment opportunities. He specifically mentioned the anticipated dramatic growth in areas like data center construction, power grids, and semiconductor plants. Crucially, BlackRock anticipates that the prevailing uncertainty could significantly benefit private markets. "We're seeing how sensitive public markets are to uncertainty and how quickly they can move in reaction to policy proposals," Fink observed. These dynamics could drive even more capital flows into private markets as investors look to insulate portfolios from tariff impact and seek attractive income and growth. BlackRock's own results reflect this trend, with the firm recording $7.1 billion in net inflows into private markets during the first quarter, primarily driven by its infrastructure and credit businesses. The firm's private markets assets under management AUM reached $212.4 billion by the end of March 2025, an increase of approximately $75 billion from the previous year. This AUM includes $108.4 billion in infrastructure, $36.6 billion in private equity, $33.7 billion in private credit, $26 billion in real estate, and $7.7 billion in multi-alternatives. Looking ahead, BlackRock expects continued organic growth in its private markets division and anticipates closing its acquisition of private credit firm HPS Investment Partners by mid-2025. The firm also recently announced, via an investment consortium, the acquisition of European life insurance consolidator Viridium Group to further expand its private credit footprint. BlackRock is also actively working to broaden access to private markets, particularly for retail investors. CFO Martin Small confirmed plans to launch a target date fund-style offering featuring private market investments on a U.S. retirement platform around the middle of this year. "We see real potential benefits to retirees in greater diversification and better retirement outcomes through the blending of public and private markets," Small stated. Additionally, a collaboration with Partners Group aims to launch portfolio solutions providing access to U.S. private markets within the first half of 2025.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.